Hi, my name is Dawn Hallman. I'm an estate and tax planning attorney, and our main office is in Norman, Oklahoma. Name of the firm is Hallman Associates. What we do is we really focus our practice on high net worth and ultra high net worth clients dealing with estate tax issues, income tax issues, and asset protection planning matters. So this video is a part 2 of a series we're doing on Deferred Sales Trust. You can certainly look at my YouTube channel and find part 1. If you just turn this on and you're like, what is a Deferred Sales Trust? You need to watch part 1. Part 2 is, how does this work? What are the mechanical pieces of this, and how does all of this fit together? There's going to be a link at the bottom of this, or on the side of it, or up at the top, somewhere on this YouTube video, of our article, my article, in the Oklahoma Bar Journal. So I wrote a very technical article on Deferred Sales Trust that will, especially for the CPAs that are watching, will love it. They can go to that article, and it will give you a little bit more of detail than what I can actually squeeze into 6 minutes right now. It'll probably go over probably like 10 or 20 minutes, who knows. You can always call our office too. We're more than happy to meet with you, your professionals, and go from there. So series 1, we talked about the Deferred Sales Trust. You know what it is now. You at least have a general overview. How does this big bad boy work? Well, there are a few technical pieces that really are important to make sure that are in place. The first one is that the grantor, the seller, the person setting it up, does not maintain any incidences of ownership. You can't keep your hand in the cookie jar, right? The IRS, as they should, says that doesn't work. If you do that, and there's several ways you can accidentally do that or on purpose do that. If you do that, what happens is the IRS calls it a sham trust, and that is actually the word they use in their opinions, which I think is great. Call the spade the spade. And so they call it a sham trust, and they unwind it. I recently got asked the question, well, that's fine, Dawn. What's the worst that happens? The IRS unwinds it. So what? I pay them the tax. I'm in the same boat I would have been in before. I was like, well, not quite. Well, usually when you get audited, it's 3 years later, because that's the window, unless, of course, there's fraud. But let's say you didn't do it on purpose because you screwed up and you didn't know, and even though I told you, and you created it, and you then, usually it's around 3 years, you then get pulled for the audit, and they go, oh yeah, it's a sham trust, we're going to unwind it. Do you just have to pay back the tax? Has anybody been audited that's watching this video? Everybody's like, the answer is no. You don't just pay back the tax. There's penalty, interest, all kinds of other fun stuff that goes along with it. So it's really important that this is done right, all the protocols are followed, and that you're using an estate planning attorney that obviously has a super strong tax background and has done this a lot of times, because this can go wrong, and when it does go wrong, it's really expensive. The key today is to take some complex concepts and make them pretty digestible, but please don't be misled that this is easy to do. It is not for rookies. This is not for your everyday estate planner. This is highly complicated. So it really must be done by, somebody like, it just has to be done by somebody that does this, that has a tried and true history of it. So we got this irrevocable trust. Super important that we have the wall that separates the seller from the trust. How is that wall created? Okay, well, we create the wall between the seller and the trust by a few ways. Number 1, the seller cannot maintain any incidences of ownership, cannot keep control, cannot be the beneficiary. So let's say seller sets this up. So who are the trustees? Trustee has to be independent. And I mean independent. I don't mean like my cousin's brother-in-law independent. So professional corporate trustees, independent style. So usually what happens is in a lot of the ones that we do is we have a corporate trustee that the client has selected, and then usually the client has also selected an investment trustee, maybe even possibly a distribution trustee. And so at the end of the day, what the client's original intent is, because the client can't keep control. It's sort of like sending your kids out into the real world, right? My job is to raise them, and I have control at some level, but when they get out in the real world, I mean, really my level of control goes away, right? That's kind of where this is. You have to create it perfectly to begin with, because you're going to lose control. If you keep it, it's a sham trust. So you're going to lose control. So you have to create it so that when it's out in the real world all by itself, it does exactly what you wanted and planned for it to do. The other key is the safety stops. My safety stop with my kids is checkbook. I don't know about you, but that works for me. So there are some safety stops that we can build into here that we obviously can talk with you about more privately, but we definitely have some legal protection measures and some safety bumps built in here so that if you do have a trustee that's going rogue or, getting all wild and crazy or doing something that they're not supposed to be doing, aside from a lawsuit by the beneficiaries, there are some other ways to get them removed and to change that still don't have the client involved, but is a safety valve. So we have this independence here from the trustee perspective. Who's going to control it? Who's going to make the distributions? How is that going to work? The other key piece is timing. So what do we mean by timing? The timing of the sale, this timing of when the sale is consummated, the timing of the sale when the dating ritual begins, if you will. So when we go to have the sale, if you're already under contract for the seller to pay you full price, it's very difficult to turn around and go, oh yeah, IRS, I'm supposed to sell it to company X over here, but instead I'm going to sell it to trust Y. When you're legally bound under contract to sell it to company X. Then you sell it to trust Y, and trust Y sells it to company X. It's going to look a little weird, and in fact, the IRS says that looks a little weird. We are going to unwind that sale because that was not an arm's length transaction. No kidding. So timing is a big issue. We want to make sure that you're not under contract yet. Planning is the key to success. So maybe you've identified, I know I want to sell my business, or I know I want to sell my property. Maybe you have somebody that has an interest, but you can't be under contract yet. I had a question the other day, can you be under a letter of intent? I don't know. My favorite tax rule is pigs get fatter and hogs get slaughtered. And I love seeing my name in lights. I don't want them in a tax opinion. So work within the parameters of the box. There's lots of great, amazing planning tools that we can do inside the box that are creative, that don't put you at risk for something being unwound and you being the product of a tax opinion with your lovely estate planning lawyer. And so the trust is then set up. The seller sells the asset to the trust. We talked about the timing. When I'm not under contract, then my third-party independent trustee turns around and sells the asset on down to the new buyer. Now, imagine if this were just a traditional installment sale. So if I just sold it to a new buyer and I took back a promissory note, right? That's what I'm paying the tax on. Same principle applies here, except I don't know that company and I'm not going to finance them. They need to bring me the cash. But I do know the trust because I made it. And the beneficiaries are people I've selected. Trustee is somebody I've selected. So I know the trust. So I'm comfortable selling my asset to the trust and taking back an installment because this I trust. Then trustee sells it to third party, takes back the big pile of cash. Then what happens? Okay, we've consummated the sale. Well, not we, the trustee has consummated the sale. And so the trustee has sold the asset. So I sold the asset, not I. You sold the asset to the trust. You, the grantor, sold the asset to the trust. The trustee, third party, sells it on down to someone else. Pile of money is sitting here in the trust. Now what happens? We're going to Vegas. No, I'm kidding. We're not going to Vegas. Trustee then is going to invest the money however the terms of the trust have dictated. Maybe they have full discretion. Maybe they can go into real estate. Maybe they can go into other closely held businesses. Maybe they can go into investments. Maybe they can margin and day trade. So when you create the trust, which is again why this is not for rookies, the terms of the trust are going to dictate the authority, the power, and what the trustee is expected to do. So trustee invests the money as the trustee directs. There is not the same limitations and restrictions, though, like there would have been, say, on a 1031 exchange, where you have to trade property for property. Most of my clients that are selling their highly appreciated property, they want to go into other things. Maybe it's investments, maybe it's a smaller property, combination of both. So trustee then will do that. trustee is obligated to pay back the installment note. Again, terms of the installment note, reason 107 why it's not for rookies, that has to be really tight. Has to be, the valuation's got to be great, the terms have to be great, they have to be a little flexible, because what if the market's down and we need to defer a payment? Or what if something happens and we want to, the note needs to be called due. There's a breach of some sort. So there's lots of things that go into that to mechanically make that work beautifully, with, again, some safety stops in there. So terms of the note are getting paid back. I always get this question. What happens if I die and there's still some of the note outstanding? Well, the note's still due. Perhaps it's callable at that time and tax gets paid and moved on. Perhaps you still want to pay that installment out so the capital gains aren't realized all at one time. But the tax treatment of the note itself stays the same. And the other question is, well, what if there's more in there? Because that's the goal, right? Hopefully, because we've invested a gross amount, it's had enough to pay me back, and there's something left over. Well, if you, the client, are the grantor and your beneficiaries are there, guess who gets it? Your beneficiaries. If it's just a third-party trust, there aren't any beneficiaries to a corporate type trust. But if it's a true, what I would call more of an organic irrevocable trust, an organic deferred sales trust, then your beneficiaries are the ones that benefit from any additional appreciation, income, so forth, that the trust has actually generated. That's huge. That's a big point to make sure to make here. Okay, now you know all there is to know about a deferred sales trust. I'm kidding. Now you've been given a really high level, intense, very quick class on a deferred sales trust. This is a 2-part video series, the overview, and then this, which is a little more of the mechanics about how it works. It is really difficult to take such a complex concept and all of the little requirements that are there and summarize that in a video. But what I can tell you is, I personally have been doing this for over 20 years. I've only ever done estate and tax planning, as has the lawyers in our firm. We've got combined 60 years plus of experience in our firm of just estate and tax planning. Everybody here at our firm has a tax background, has either a CPA, has worked in accounting, has worked at maybe one of the big accounting firms. And so our base knowledge is tax, and then we couple that with estate and tax planning on the legal side of it. So we're very great at what we do. We're really bad at anything else, but we're great at this. If this is something we can help you with, or if you're a professional and you're watching this and you feel like this might be an option for one of your clients, please contact us. There's a link to our website at the bottom. Our phone number is 405-447-9455. There, again, and earlier in the video is the link to my article in the Oklahoma Bar Journal on deferred sales trust. So hopefully we've given you some resources to at least take a 30,000-foot view approach and see if this is something you want to explore more. And if it is, give us a call.